Hi, I'm Vishnu Srinivas, and welcome to Hawkeye, a podcast featuring prominent business professionals and their views on topics impacting businesses and economies around the world. Make sure you rate, review, and subscribe. Joining me today is Professor Arpit Gupta. He is a professor of finance at NYU Stern. Thanks so much for taking the time to speak with me today.
Thanks so much for having me, Vishnu.
So, do you want to give a short introduction about your background and your role?
Absolutely. So, as mentioned, I'm a professor of finance at NYU Stern. I focus primarily on real estate, but also work in some other areas, including private equity and household finance. I got my PhD before this at Columbia University, so I've been living in New York now for about 13 years.
Awesome, yeah. And I guess as a professor at Stern, how do you decide on what your next area of research is going to be focused on?
Yeah, it's sort of a combination of trying to address things that I think are interesting to the world that people will want to know about,
Mhm.
trying to find things that are contributions to the literature. So they're going to be things that the academic community is going to find novel. In conjunction with, is there a data set, some unique contribution I can find in terms of the analytics I can bring to bear to a question? And then also, can I find the right collaborators, right?
Mhm.
All of my projects, basically, as the case for most academics, involve teams. And so I'm also always looking for projects that I can involve other people with. And so
Right.
it's trying to find and triage kind of the mix of those for things.
Yeah, definitely. And focusing on a specific part of your work, I was reading an article of yours recently where you were trying to analyze the roots of the inflation issue. And obviously, in some countries, like mostly in Europe, they're feeling the effects of the supply shock to a
Right.
greater extent. Whereas in the US, it's been more about the excess consumption since COVID. Do you
Right.
think these two scenarios make a difference in terms of the policy you'd use to rectify this overarching problem of inflation?
Yeah, absolutely. I think in Europe, if you're looking at this, seems like more of a supply driven situation, seems like a lot of energy concerns. I think the kind of the appropriate policy mix is one to try to address the supply shortage. And that can include, in Europe's case, things like using more nuclear energy and also having more LNG terminals that can import foreign liquefied natural gas, particularly from the US, but also countries like Qatar and others. And that means, as a consequence, you might be less concerned as an ECB about raising rates and trying to dampen things on the demand side, given that you think that a lot of the issues are really supply driven. And those are probably unlikely to lead to the same kinds of unanchored runaway inflation that you might get on the demand side.
Yeah, definitely. And in this context of inflation, we have a question from a fan at on Twitter at thischina who wants to know if other countries will follow Japan's low economic growth model that's been there for the past few decades.
Yeah, one comment I would have first is that I think it's time for a little bit of a reassessment of the Japanese, you know, quote stagnation. The reason, of course, it was such a big part of discourse is that Japan was seemingly stagnating after a period of very meteoric rise and kind of stagnating relative to other developed countries around the world, right? Particularly in the 1990s. That's when they had a lot of the issues around banks that had these zombie banks, and it seems like an economy that was kind of not really advancing to the same level. But I think when you look at it over the context of the last, let's say, 3 decades, and then you continue to put it in context with other countries, I think it kind of hits differently. You see kind of a country that has coped with really substantial economic shocks that have not had a huge political fallout. The political system has more or less managed these issues. You see unemployment hasn't really risen very much over the whole period. And in fact, female labor force participation is quite high and higher than the US. So
Mhm.
historically, Japan always had an issue with female labor force participation. Whereas now it's actually the US has a lower value of that. You also see that fertility, though it is fairly low by global standards and it's below replacement, it's actually on the high side for East Europe, or sorry, for East Asia.
Mhm.
And then finally, you're just kind of looking at a society that generally has a very well-functioning housing and transportation system. And these are the two things that every other country, every other developed country in the world is struggling to figure out how to do.
Yeah.
So I think you can kind of look at Japan in many ways as just a successful modern country that's doing a broadly pretty good job at, especially, meeting citizens' basic needs. Its crime rate is incredibly low compared, of course, to other countries. So they're in many cases a success story, not so much not so much a downside. I think the biggest issue that you could flag with them is this demographic transition story. So the fact that Japan does have this low replacement fertility rate has been a little reluctant to increase immigration, though that has gone up in recent years. And that does seem to be a situation that more and more countries are going to find themselves in. And that has all sorts of ongoing implications on things like the natural interest rate and how to kind of cope with this kind of demographic decline.
Yeah, definitely. I think it's important to keep those different factors that surround Japan's unique model in context, rather than just like focusing on this one idea of its slow economic growth. Shifting gears to another kind of concept that's really fascinating in the real estate industry. As vaccinated people try to return to these pre-COVID lifestyles, do you still think it makes sense, both in financial terms and productivity terms, for companies to have people come back to offices?
So just in general, does the office kind of make sense
Yeah,
for firms to?
both from like a financial standpoint of like maintaining that real estate, and also from, I guess, the productivity standpoint of like people's work effectiveness or whatnot.
So from the firm standpoint, I kind of view the office as just a really big cost they're incurring, right?
Right.
It costs a lot of money to lease office space, to lease sufficient space to have all your workers come in. And so if your workers are telling you that we'd just rather stay at home, it seems like one impulse the firm can do is just say, okay. So we've seen the latest research that's come out now from Nick Bloom at Stanford, who's been, of course, researching this intensely for many years. It's an interesting story. Workers will accept as an amenity being able to work from home and then demand less in the form of compensation, right? So they're trading off more flexibility in exchange for lower wages. At the same time, from the financial standpoint, you don't have to spend money on your leases. Now, leases tend, of course, to be set in place for many years. So they're kind of long-term in nature, 5 to 7 years, something like that is kind of typical. And so you're not able to change your leases immediately. What you are able to do is either sublease the space, so try to find someone else who can take it over in the short term, or when you do have your leases come up, decide what you actually want to do with it. And again, this is just like broadly a big expense for many firms. Now, the JP Morgans and the Goldman Sachs of the world, they're, let's say, rich and financially unconstrained enough such that they're mostly concerned about other things and not so much the specific expense line of the lease. But a lot of firms out there for which this is like a pretty substantial expense. Just to give you one example, the newspaper industry has actually been shedding real estate even before the pandemic, because it's an industry for which financial constraints are just much more binding. So the workers want it. It's actually financially better for the firms to offer it. And the real question is about the productivity and the broader consequences, I think, on teams. And here, my read of the evidence is basically that the short-term productivity effects are sort of fine, and the effects for people that already knew each other are basically fine. So you can collaborate, effectively the same as you could before with people you already know in the short term. I think the real question marks have to do with incorporating new people, onboarding new people onto the team, and figuring out how you're going to maintain the same level of your kind of corporate culture, and how you're going to do things in the long run, which especially gets into the area of collaboration, disruptive innovation, things that aren't necessarily just continuing your business operations in the short term. And those are, I think, more open questions. But I would say that those kinds of topics, the culture, the onboarding, working with new people, and disruptive collaboration and all that's, it's not clear what kind of space is optimal for that. So what we did before the pandemic is we basically just had these offices and let people passively talk to each other. And that was, we knew back then, good enough for these kinds of purposes. And the question that basically all firms are asking is, well, do you need 5 days in the office for that? Do you need 3 days in the office? How many days in the office do you need? Or if you're not going to do regular office visits, are there other types of activities like offsites, happy hours, other ways of kind of bonding that help us reach those same goals?
Yeah, definitely. I think quarantine definitely forced firms to like kind of weigh all these different costs and benefits of work from home lifestyles. And I think it's going to be really interesting to see how they move forward in this post-pandemic, responding to all those kinds of effects they saw and noticed. Next, we have a question from another fan, Kulpa Vriksh Cap on Twitter. And he wants to know, I guess I should frame this in the context of we always see people like bagging on the Federal Reserve for like not really taking any issues seriously or not coming up with productive solutions to real world problems. So he's kind of asking what tools are available at the disposal of the Federal Reserve or even the government for that matter to solve extreme inequality in the US.
Yeah, I mean, I would sort of err on the side of saying that I don't really view that as the prime goal of the Federal Reserve.
Yeah.
I think they have enough on their plate with inflation. And part of, I think, what happened over the last couple of years is the Fed got distracted a little bit away from its main goal as they started to look into other goals, climate and so on and so forth. And so I would, primarily say that this is, not a topic for the Fed. There are a lot of things the federal government in its other capacities is able to do. I would sort of separate here income and wealth inequality. A lot of the discussion is on wealth inequality, but income is, maybe more relevant in certain ways. And thinking about the different parts of the distribution, right? Whether you're looking at the bottom and you're trying to adjust inequality at the very bottom relative to the median person, or you're trying to tackle that very top end wealth inequality, particularly on the wealth side. And I would actually say that there has been a lot of progress towards trying to address the inequality problem from the bottom end. So we've actually added a lot in the way of welfare programs and different support mechanisms that help low-income Americans meet, basic necessities. And we've tried out new things even during the pandemic, including the child tax credit. So I think there's a lot of fiscal support mechanisms that could be, broadened and expanded if the objective is to try to address that, extreme inequality.
Yeah, definitely. I think we have to also keep into context of what the purposes of these institutions are and what they're serving in society. Like they can't really address all kinds of issues that aren't pertinent to them or what's in their realm of power, I guess. These next few questions are from a huge follow of your work. They're from Pradyu Prasad, and yes, a ton of questions, and there's a few that I want to get to. Firstly, he's asking whether ESG investing changes factorless income, which is a concept introduced by Karabar, Bunis, and Neiman, which you've referenced a lot. So I guess we can start off by like defining factorless income, and then we can get into his question.
Yeah, so the concept there is to try to take in the national accounts and to try to ascribe to different factors their share of production, and the residual is going to be left over as the factorless share, right? So we've got wages, we've got the return on capital, and then we've got some a little bit of a black box. Mm-hmm. And the basic puzzle is I kind of understand it from the capital side, is that we've kind of seen interest rates go down a lot over time. So that's going to kind of mean that the user cost of capital is also going to kind of go down in tandem. So that means the cost that a user of capital pays for their being able to use that asset over a period of time. Mm-hmm. And what we have not really seen change in tandem with that is actual investment. So we haven't seen capital itself sort of rise as we would expect with changes in the price of capital. That's sort of like the basic sort of puzzle that I think in that area. And part of that sort of has to do with inflexibility in hurdle rates or discount rates used by firms when making investment decisions. So when firms are deciding what to invest, they're often setting a number and saying, okay, this is our hurdle rate. We're only going to invest if a particular project's cash flows yield an IRR that's in excess of this kind of hurdle rate.
Right.
And that kind of capital budgeting process means that you will leave a lot of projects on the table, even if the actual interest rates is kind of falling below that, right? Where ESG, potentially comes into this, I think, is with respect particularly to the energy sector. They might be, as a consequence, even more inclined to do this sort of thing.
Yeah.
By this sort of thing, I mean not investing in positive NPV projects at kind of conventional market discount rates, because they're employing an internal standard of investment that is higher than that, because of concerns, right? And these concerns can include ESG concerns that you don't want to necessarily engage in kind of dirty industry sort of things because of the kind of publicity that sort of results in. So it's plausible, I guess. It certainly seems like the energy industry has not been very rapid in their response to the recent price run up, and you certainly hear a lot of speculations that ESG is one of the factors behind that. And that's sort of an example of this broader trend of firms not responding to kind of market signals the way we would like them to, and increasing their investments.
Yeah, I think the ESG investment model takes into account a lot of different kind of factors that maybe traditional investment portfolios are not exactly weighing that heavily. So that's definitely important to keep in mind. Second question that he has is that he concludes that a lot of private equity is owned by a few large investors trading things back and forth. So accounting for this, how real are the returns in private equity? And I guess you can also conclude whether you think his assessment of private equity is correct.
I dispute the premise a little bit, in the sense that my sense is that so the private equity model, right, is buy some sort of asset and operate it for a period of years, and then realize a gain by having an exit and selling, disposing of that asset,
right,
and then returning that money back to your LPs. So my sense is that the majority of these exits are still going to happen with an investor realizing a market price, whether that means the portfolio firm is going public, whether that means that they're going into a SPAC or some other source. And to the extent that it is a private to private transaction, you're reselling it to someone else. The person you're pre-selling it to doesn't really have an incentive to overpay for the asset, right? You'd have to structure a situation. Well, I'm going to overpay on this asset. You're going to overpay when you buy them at comparable other. That kind of collusive activity, I think, is just a little generous. I think it's much more. I think it's much more likely that the transactions are happening at more or less fair prices, I would say. The hard part about the returns is really just how to interpret what's happening in between the time that the asset is bought and then the asset is ultimately exited and sold at the end. And that length is often changing. So a lot of the venture capital funds are going towards even longer duration holding models. Some of the private equity firms like Fortress in particular have already gone in that direction as well. And so that spreads out the time that you are just holding the asset without having realized a market return. And however long this is, you need to figure out what the return is in the interval. And the conventional practice in the industry is to report some sort of net asset value, some sort of estimate of the portfolio firm's valuation. And and everyone understands that's kind of a smooth estimate. That's definitely not real. And many people believe, Cliff Assis believes, I'm certainly sympathetic to this view as well, that's in fact the secret sauce of private equity. The fact that you're purchasing a claim onto some asset, and every quarter you're going to get a financial statement that tells you your asset's fine. It's going up by some smooth amount, and this insulates you from the volatility you otherwise observe in financial markets.
Yeah, definitely. And so I guess just some slight pushback on the premise, but it's definitely a fair for critique of some of the practices of private equity. Last question from Pradyuman. Obviously, really appreciate him contributing hugely to this podcast. How would you redo India's economic policy during COVID in hindsight? So I think for context, India was obviously one of the countries hit the hardest by COVID. And now recently they've emerged as one of the faster growing economies in the world. So now that I guess we have all this information about what worked, what didn't, how would you do it over?
Yeah, I would. I guess my guess at this point is that in the hindsight policy would be something kind of like Pakistan, what sort of Pakistan did, which was basically very little. And the reason is not because COVID mitigation policies are useless. Certainly many countries that have had, I would argue, effective COVID policies. The challenge is that they're simply require a higher degree of state capacity. So India had, as of course you know, a fairly strict initial lockdown.
Yeah.
That was fairly costly. Itself seems to have spread out around the disease a little bit to the extent that migrants are, kind of moving around in the aftermath of the lockdown, and was not sufficient to eradicate the disease, and so then just kind of pushed on cases a little bit further on later on in time. Now, I think the one part of this policy regime that did work well, and I guess in my ideal would expand even further, is the system of international kind of international restrictions. So India was able to push back the date at which cases started to rise more than countries like America because of the strong degree of restrictions on international travelers, right? They had to kind of come in and get tested and so forth. But it wasn't as strict of a regime as countries like South Korea and others that really had strong restrictions. Now, that seems like a natural, again, my hypothetical alternate policy, that seems like the natural area to like really focus on. Just have like a very strong regime that limits, entry. Because what happens in the end is one person breaks through the quota and it spreads COVID throughout the whole country. So ultimately there's a small amount of international travelers, and I think you can just have a fairly heavy hand in kind of dealing with international travel in general. You can basically eliminate it for anyone who's not a national citizen. And of course, for citizens, you have to take it back in the country. But I think you would have a fairly restrictive regime, and as South Korea did, in terms of how to handle that population. And that probably would have been sufficient to delay the spread of the disease into India by some amount of time. It probably wouldn't have been 100% effective, but then the hope is by the time that the disease is then able to kind of spread, you're able to then gain a better understanding of how to treat it and so forth, and then kind of go from there. So then I don't know that the initial, again, it's all hindsight, so I don't know if the initial degree of lockdowns was warranted, to the extent that if you are starting from the standpoint this is a disease that once it gets into India is now just going to kind of circulate for a good amount of time. I think the scope of limitation seems far different. Masking, of course, is something that the government, and I wrote an op-ed on this issue back at the time, is something that the Indian government should focus on. So there are a lot of those kinds of interventions, I think, basically the low cost ones that can try to address mitigation that kind of made sense, but the kind of harsher lockdown policy, I think, just kind of pushed a lot of these cases further into the future. And then certainly doing more to harden the healthcare system, have enough oxygen gas canisters and so on, would have been helpful at the time that Delta hit.
I think less can definitely be more, especially if you're focused in strongly on those select few strategies. Awesome insights, Professor Gupta. I really appreciate the time, and thanks so much.
Yeah, thanks so much for having me.